Welcome back, investors, to Ticker Time News. I'm Adam, and today's trade had a distinctively negative disposition. After opening in positive territory, the S&P 500 pushed above the 3,700 level right after the open, but quickly the market switched its gears and spent the rest of the session in retreat mode. You can see it. This is the SPX on the chart for the S&P 500. This is the 5-minute view. So we have yesterday's algorithmic rally. That's what I'm calling yesterday, an algorithmic rally. It was computers firing off all their sensors. Oh, hold on. A little algorithmic rally. It was come on now. Firing off all their sensors. Come on now. Oh, hold on. A little algorithmic rally. Come on now. We're having a little bit of a live stream malfunction there. I forgot to turn the volume down before going live. So, okay, now that's fixed. Let's get back into it. So on the chart, this is the 5-minute view, algorithmic rally yesterday, taking this thing on a joyride without a license. And then today, well, we had to give up those gains, but not before a little bit of magic at the open. Because like I said, we got really high this morning before having to cool our jets. Right here. This is the high this morning, up above the 3,700 level. When just yesterday, right at the low, we were underneath 3,500. That's a 200 point from trough to peak right there from yesterday and then into this morning. But now, well, things need to get back to reality, because when the computers trade, they're trading in a simulation. They're not based in reality at all. As far as I'm concerned, really, no fundamentals in the market changed at all, except for one glaring fact. Inflation still remains hot, right? Now, the S&P 500, it swung more than 100 points today from its peak to trough low, which was right before the close is when it hit its low of the day. It closed at 35.83, well below that 3,600 level. Now, there was likely a feeling that the market got completely carried away yesterday with its rally after a disappointing September CPI report that showed core CPI was at the highest level since August of 1982. Let's see. What was I, like 3 years old at the time? My goodness. 1982. That's the highest for core CPI. That is incredibly high inflation. But there were other factors in play too. The stock market, it reversed course around the same time today. Again, at that just above 3,700 level, about at the same time that the UK Prime Minister Truss said in a press conference that the UK will keep its planned corporate tax rate hikes in place, in effect, and that the UK will deliver a medium-term financial or fiscal plan on October the 31st. I know all of these headlines going on in the UK affecting the markets here in the States. Why is that? It's because it's not just any headlines. It's not that they're just political headlines in the UK. It's because of the UK's financial system. And a lot of times things happen over there first before they make their way to our bigger financial system. Now, in other words, of that medium-term fiscal plan, the mini budget isn't being scrapped altogether. The 10-year gilt yield, which is the UK's version of our bond market, fell to 4.07% overnight on speculation that UK's finance minister might just get fired today. And he sure was. And that the Prime Minister Truss might scuttle her tax cut plan, which rose 19 basis points to 4.38%. The U.S. dollar index, let me throw that up on the screen. First, let me take these two highlighted areas here off the chart. I'm going to go to the daily view, and I'm going to pull up the US dollar index. The ticker symbol is DXY, or the Dixie. It was up 0.8% today to 113.27 following the news in the UK. And you can see just about perfectly on the US dollar index today, what was given up yesterday was all gained back today. Like, well, nothing happened over the past 2 days. It was a flat trading session when we know it was one heck of a ride. Now, the big moves in the gilt in currency markets reflected uncertainty about the week ahead after the Bank of England ended its emergency liquidity support for the gilt market today. So more headwinds for the stock market came in the form of rising inflation expectations, as seen in the preliminary October University of Michigan Index of Consumer Sentiment, and of course, rising treasury yields in our own bond market. The 10-year yield settled above 4% and added 6 basis points on the day, then 13 on the week. It settled at 4.01%. The 2-year yield rose 5 basis points on the day, but 20 basis points on the week to 4.5%. That thing just keeps on rolling. Notably, though, the Dow Jones was able to squeeze out a gain of 1.2% this week, despite today's broad market sell-off. Okay, let's go look at the sectors here, and then I'll end the live stream on the SPY, the Qs, and the IWM. Looking at the sectors here, boy, it wasn't very pretty today. All 11 S&P 500 sectors closed in negative territory. Consumer discretionary, XLY, down 3.9%, had the biggest loss, while healthcare, down 0.8%, had the slimmest loss. Now, the healthcare sector had some help from Dow component United Health, ticker symbol UNH. It was up 0.6% today after the company reported favorable quarterly results. Now, losses for the financial sector, which is a big weight on the SPY and the SPX, ticker symbol for the financials is XLF, they were notable, but less severe thanks to the gains in JP Morgan Chase, up 1.7%, Citigroup up 0.7%, and Wells Fargo up 1.9%. They all reported better than expected earnings before the market opened today. And that's why when we look at the SPY and the SPX, we have that spike first thing in the morning and a tiny little gap up this morning. It's because the banks produced some pretty decent earnings results. Now, it wasn't all sunshine and rainbows. There were some problems. Now, looking at today's economic data, we got total retail sales. They were unchanged month over month in September. The expectation was a positive 0.2% gain, but it just wasn't there, following an upwardly revised 0.4% increase in August. Now, if you take out autos, retail sales were up 0.1% month over month. The expectation was that to be flat. Now, that followed a revised 0.1% or 0.1% decline in August. Now, this retail sales report, the key takeaway here is that it is not adjusted for inflation. So the lackluster number of being flat month over month in September suggests consumers were pulling back on spending activity in the face of high inflation. Then the preliminary October University of Michigan Index of Consumer Sentiment, it rose to 59.8. The expectation was 58.6 from the final reading of 58.6 for September. In the same period a year ago, just to put this number in context, the index stood at 71.7. So, what's the takeaway here? The report is that inflation expectations for the year ahead and for the 5-year period increased from September, creating some uncertainty about the strength of consumer spending activity in the coming months. Not looking good. The consumer is weakening. I've been saying that since the beginning of the year, right? The beginning of the year, the consumer was strong. Middle of the year, the consumer's been weakening. End of the year, the consumer will be weak. I've been saying it since January. It's I'm a little bit, what would I say? I'm a little bit early, just a little bit, because now the consumer is really starting to show signs of trouble. Now, ahead of Monday's open, Bank of America, Charles Schwab, BNY Malone, my apologies, they will all report their earnings. Economic data on Monday is also limited to the October Empire State Manufacturing Index. The prior reading was negative 1.5. Both come out at 8:30 a.m. Eastern. Now, I'll go back to the SPY and the Qs and the IWM. Tesla got smoked. Yeah, Tesla is one that, it held up pretty well beginning of the year. Yeah, it was down. But a fall from Tesla is definitely TSLA. Let's go ahead and, oops, I'm typing buttons on the wrong screen. Pull up Tesla here. TSLA is the ticker there. Yeah, Tesla's got a long road ahead of it. And, this is the daily view. And look at that. Over the past month or so, Tesla's really gotten hit pretty hard here. All right, let me open this up a little bit. I want to pull it up and get today's candles out of volume territory. All right, up you go. Up you go. So yesterday, one of our probabilities, and it was one I was leaning on, is that yesterday was a one-time event, and that's what we got today. Tesla yesterday up 2%. Today, man, down 7.5%. That's a big drop. Big one for sure. Wow, those daily candles are massive. Yeah, they are. Tesla is a volatile company. It moves with big swings. That's part of being a Tesla investor. But hopefully investors may have lightened the load on Tesla a little bit, especially this year. A lot of EV companies got hit today to the downside, pretty darn good. But Tesla, if you get our weekly expected moves every Sunday evening, if you notice on the stocks that we do weekly expected moves for, Tesla has one of the biggest possible swings up or down of any of the other companies like Apple or Microsoft or Alphabet or Meta Platforms or Netflix. Tesla always seems to have the largest possible swing each and every week. And that just goes to show the volatility in Tesla stock. All right, let's pull up the SPY here. I want to look at, actually, my apologies. I need to pull up the SPX first and then the SPY. I have most of my drawings here on the SPY. Oh, watch out for the spam in the live chat. Okay, let's open this up some. Obviously, we all know we had an island top reversal pattern. It was right here. That's when you have a gap up, you have a few trading sessions, and then you have a gap down. That usually marks a top. And it coincided with the 20-day moving average and the trend line all coming down on top of it. Then today, we talked about the 20-day moving average and the same trend line right here as possible resistance for it. And we were talking about, what was it, 3690, 3685 or so. And it did happen to pop up above the 3,700 level very briefly, maybe like 15 minutes or so first thing this morning. But then it fell from that. So you can see yesterday in that giant candle, that was an algorithmic trade right there. That's the evidence right there. Computers stepping in, the technical level. We had the 3,500 level, which is a very strong support level. We had the 50% retracement level of the pandemic rally right around that 3,500 level. And we had the lower expected move for this week at 35.15. So we had those three as a trifecta of support yesterday, and with that 3,500 level being so significant and it coinciding with the 50% retracement level of the pandemic rally, computers, they just all stepped in with their algorithm and said, we need to buy. This is the time to buy. Flip a switch, ready to go. Let's rock and roll. Bid this baby up. And that's what the computers did yesterday. So that's why I call that an algorithmic day. It was computers trading. And then add on top of that, extremely over, what would I like to say here? An extreme bearish sentiment from the market participants at wide or at large there. That too caused a bit of a short squeeze to happen. Now, the problem with this is when you have an algorithmic trade like that, it's not people that are trading, it's computers that are trading. Computers are not seeing reality like people do. So the fundamentals of the market, all they did was get a little bit worse yesterday with inflation coming in hot, meaning the Fed is not going to slow down the pace of their tightening cycle. They're not going to slow down their pace of hiking rates and hiking them at large amounts, 75 basis points, maybe up to 100 basis points at this point. So it is still all negative out there. That's why yesterday when we mentioned that, we could be looking at a one-time event, that's exactly what we saw. Exactly what we saw. Puts went crazy today. Wish I had my Tesla puts. Yeah, that would have been smoking. Right back to your first comment. Yeah, that would have been awesome. Okay, so what are we seeing here? Next week, the options market is probably going to come in and price the market a little bit lower with the weekly expected moves. At least that would be my initial take here, that they're going to lower those numbers down. How much? I don't know, but we'll see what the implied volatility is and the whole formula and see what it works out to being. But I would imagine it's going to be lower. And then that 3,500 area on the S&P 500 is still a very critical level. If we could get a close on the 3,500 level, that could coincide. And again, I got to pull up the seasonality chart right here, because when we were talking about this thing yesterday, remember, we said that there was it's the red line that we're looking at. There was a sell-off, right? It got to a new low for the year, which that's what happened on Wednesday. We closed at a new low for the year. And then let me clean these two marks up. But if you can see it there, there's this, it goes down to a dip, right? A point where it stops, new low for the year. And then there's a little bounce, a little V-shaped bounce recovery right there on it. And then there's a much bigger sell-off that takes us to a new low for the year. And it marks the low for the year, which should be somewhere around the 1st of November. So as we have that in the back of our mind, we can't help but look at setting a new low for the year on Wednesday, Thursday getting this rebound, and then of course today selling off. We could imagine that we could go even lower next week as we go into the end of October and hot into earnings season, right? We had a lot of financials report today. And we are now officially in earnings season, Q3 earnings season. We'll see how that's going to play out. All right, let's go over to the SPY here. Now, for the SPY, very similar setup here as we had with the SPX. I just like to use the SPX because there's more volume going in and out of the SPX compared to the SPY. So the data is a little more spot on. But same thing occurred here. We had this trifecta of support at the 350 level. It did dip a little bit below that, just like it did in the SPX. It dipped a little bit below 3,500, bounce from that, and then we get a gap up this morning right to the trend line that comes down through here, right from the highs from the summer rally. And then the 20-day moving average as well. They both kind of met there at the same place, putting a lid on today, just about the 370 level. 368 is where it opened at, and 370 was its high. So then a sell-off down to the close today at 357. So the 350 mark, it is still going to act as a support area. And as I was mentioning in the SPX, if we get a close right on that 350 on the SPY, that could be the low for the year. 350 could be the low for 2022. And then we could potentially bounce and rally from that. I'm not calling 350 as the low of 2022, but I am saying that there is a probability, maybe at least 20%, that 350 could be the low for 2022. And then we can rally off of that, still ending the year in negative territory, but setting up a sell-off in 2023 to undercut 350 as the potential, the low for 2022. I do think in 2023, as long as everything plays out that's kind of like being predicted, that inflation stays sticky, the consumer weakens, we get a rising unemployment rate, and we get into a recession. The deeper and wider the recession, the deeper and wider the fall on the indexes and other equities will be. Now, remember yesterday, well, wait, let me hold that thought, pin in it, put it over here for just a moment. Let me go to the Qs over here as well. Let's look at the Qs, IWM, and then I have a thought on Bitcoin here that you guys might like. Okay, for the Qs, let's open this up just a little bit here. Get the candles out of the volume. Goodness gracious, big volume spike today. Okay, so for the Qs, we have the 20-day moving average. It's declining. We also have a trend line that is coming down here as well from the summer rally high. We have a declining 50-day moving average. The 5-day EMA, everything is connected to it, even though at the close we are off of it. We closed at 260. The 5-day EMA is at 265, but we did go through it today, so that circuit is connected. We don't have to worry about that. But yesterday, we came down. We set an intraday low for the year. What would that be? What was that low? 254? Is that correct? 254? Yep, 254 was the low for 2022 intraday for the Qs. Now, again, algorithmic bounce day, whatever you want to call it, but then the sell-off today, and it ends right down here at the 260 mark. Now, for the Qs, let me go back here, and I want to show you this. Remember, on the SPX, 3,500 is a big number. On the SPY, 350 is a big number. I want to show you the big number here and where it matches up to for the Qs. Okay, I got to pull this up a little bit. Yeah, it's not deep enough yet. I got to bring some up. It's a little too deep. Not deep enough. It's a little too deep in the weeds here. Okay, so we've got this support level, a couple of them. Let me show you here. Number one, there is a support level right here at about the 255 mark for the Qs. But below that 255 mark, there is this very steep rally that occurred back in July of 2020. To get down, we really have to go deep here to right about the $240 level. That's deep for the Qs. 240. That is really deep. And if we look, where was the February 2020 high? Well, it was 235 right there. So let's open that zone up. And as a matter of fact, I'm going to go ahead and add it right now so we don't forget. And that way it's on here. You can see me add it live. For the Qs, I am going to put a zone, a box here. Let's start it down at 235, okay? And then it's going to go up to 245. A little bit more. Oh, okay, I can fix that over here. All right. So let's go in here on TradingView and your coordinates, right? Price, we want this one at 235 and this one right here at 245. Press OK. Everything lines up. This is our box. Let's change that color. Make it red because this is a warning area here. If the Qs keep going, this right here, and let's open it back up for today, for today's candles. That is saying those numbers, 235 to 245, it sounds like, whoa, that is steep. But when you actually open it up and start looking at where we are right now, it doesn't look far off. As a matter of fact, if we measure from our close today at 260, and we just go to the top line of this, okay, 245, that's basically a 6% drop in the Qs. We dropped 3% today. The Qs dropped 3% today. So it's only 2 more days like today, and you would be at the top of that box. So it's really not that far away, even though that number, 235 to 245, sounds ridiculous. We're not that far off. That could be the box for the low of 2022 for the Qs. So it's something that I'm watching very closely. Let's clean this chart up a little bit better. There we go. But we got to bring it up. All right. Small caps, they held up a little bit better than technology did today. There, you can see overall right there, it's not that far off. All right, just cleaning this chart up. We'll go to the IWM, and then we'll go to Bitcoin. I've got a thought on Bitcoin. It might sound a little crazy, but after thinking about it, looking at it yesterday during the live stream, I think we might have something here. All right, so there you have it on the Qs. You saw me put the box on today. Mark that on your chart. Could that be where the Qs are going for the low of 2022? And then, of course, once we get closer to 2023, we'll have to rethink how that might play out. All right, let's open this up. Crypto has not moved at all. That's part of the point that I want to bring up. It's definitely nothing negative on crypto. All right, IWM, same thing yesterday, except with its move yesterday and its sell-off today, it has remained within its weekly expected moves, which 161 was on the low side, 175 was on the top side. So that was your risk range. And the daily expected moves that we've been testing now for a few months, we periodically send it out to our private investor community. They have been so spot on a daily basis, especially with the big 2 sigma move from yesterday. Whew, we're about ready to release those on a more normal basis. We just want to make sure we get those tweaked just right. All right. So where could we be headed for the IWM as far as the low? Well, let's go. We got to go back and look at where we came from, right? That helps to determine where we are going. Now, one of the reasons, and I talked about this last week, that small caps had been holding up much better than the SPY or the Qs over the past week or two, right? That's why that blue line is ascending. Let's get the highlighter here. Over here, that's why I put that ascending trend line right there, because they were holding up pretty well. Why is that? Because right here was an area. Oh, come on, highlighter. Right here was an area of support from back in October of 2020. That's why that 163 area had been holding up so well. And if I back this up a little bit more, right? Look at this. This high right here, February of 2020, right here. This is at about the 268 to 270 zone right there, okay? That is interesting. Small caps are already trading under the high of the pre-pandemic, right? Which was February of 2020. If we want to go back to the highs of 2019, then we're looking at, really, we're going to look right here. 19 was all through here. That's January through December, and it's about 150, maybe stretching it to 160, okay? And then if we come here to August of 2020, that's at 158 to 160. So I would feel very comfortable putting a box for potentially the low of 2022 being somewhere around that 160 area on the high end, going down to about 155 on the low end. All right, so let's put that there and we'll update that here. All right, so we want 160 as the potential high, and then 155 as the potential low for the zone. So that's where I could see the low for 2020, oh my gosh, 2020, 2022, too many 20s. 2022 potentially playing out for small caps because they've been beaten down way more than the Qs or the SPY or the SPX. So again, we're not that far off. We almost came close to tagging that today. Okay, now let's go to Bitcoin. Bitcoin. Yesterday, when we looked at Bitcoin, I told you about my box. It's been there for a long time, from about 16,000 to 20,000. I think that could be a good area for Bitcoin to base out. before its next bull run. Now, here's a thought. What if, okay? What if, remember all the talk about Bitcoin being a hedge against inflation? What if Bitcoin needed to get down to a certain level, and that would be the lowest it would go, and that would be its hedge on inflation? Inflation came in hot. We had algorithmic trading yesterday taking place, short squeeze activity taking place, short covering taking place. What did Bitcoin do yesterday? It stood still. What did Bitcoin do today in the face of a 3% decline in the Qs? It stood still. Maybe this area, $18,500 to $20,000, that zone, what if that zone is the hedge for inflation? Could it be? Or is this just simply overthinking it, and this is Bitcoin basing out for its next bull run in 2024? What do you think? Could this zone, 18,500 to 20,000, be the zone for hedging against inflation, hedging against the Fed, hedging against the Fed breaking something? Or am I overthinking that? Let me know. What do you think? Or is this just Bitcoin basing out, forming that base to support its next bull run in 2024? It could be either or, but I find it very, very interesting that Bitcoin has been very stable. If we zoom in here and open it up a little bit more and just look at the past 3 weeks or so, how steady Bitcoin has been. I mean, look at this. This zone right here. Look at that. About 18,500 to $20,000. And we can do that here. I'm going to go 20,000. And then I'm going to take it to 18,500. That's like the zone, right? Let's change that color. Highlight it there. That's like the zone. Bitcoin is being so stable. It's interesting to me, and I find it fascinating. Okay, well, I've cut through all of my notes today. I know it's a Friday evening. I know it's a little bit later. I usually don't have too much to go through on Fridays because I want you guys to have a great Friday evening, a great weekend. I will say this, though. For our investor community on Patreon and Discord, earlier today, you got our week ending recap and wrap up note emailed out. It hasn't got up on Discord just yet. I'll put that up on Discord when this live stream is over. Tomorrow, I have a very interesting take that'll be going out. It's our normal Saturday note that goes out. It's going out tomorrow morning. Sunday evening, right on schedule, we have our updated weekly expected moves for the upcoming week. I will also be including the daily expected move for Monday as well. So that's coming out Sunday evening. And then Monday, we'll be back here for our live stream after the market has closed. And of course, you'll get our normal notes throughout the day. So that's it. If you could do me a favor, it's a huge, huge help. Clicking that like button helps out this little old channel very, very much. Clicking the first link in the description, that'll take you to a place, to our Patreon, where you can sign up to get our Saturday note, our weekly expected moves on Sunday evening, and all of our notes and numerous trade setups and so forth throughout the week. So click the first link in the description to do that. Click that like button, and we'll wrap it up here. All right. Thank you guys and gals so very much for joining me. All right, I see that just popped up. Good thing I caught it. Do you think part of this drop was just CPI reality hitting? I do. I do. Like I said at the beginning of the live stream, with the algorithmic trading, the short squeeze happening, those are things that were taking place because of a program. There was a program set in place that when the market reached 3,500, pop a bid, which caused shorting to have to cover, causing it to go up even more. So it was a cascading chain action. That is not reality. When it's algorithmic trading and the computer's doing the work, or you have an automatic stop loss, whatever the case may be, a bid already set, the computer's not seeing reality. The computer's just seeing a simple buy or sell order. We, as the human inputting these trades, see the reality. So yesterday it was computers not paying a bit to reality in what was going on. Today, it was like that mistake had to be fixed and sold into strength, right? That's what happened today. Reality hitting the faces. Everyone got giddy because the market was running yesterday in the face of hot inflation. But today, we have to bring it back down. And this market has not seen its low yet for 2022. The Fed on November the 2nd, 2 o'clock in the afternoon Eastern time, will hike rates. Do they stick at 75 basis points? Or do they pop a 100 basis point rate hike since inflation's not slowing down? That core CPI number was the highest since August of 1982. I forgot for a second. That's pretty high core CPI. That's pretty high inflation. And the Fed, because they lack the controls to control food and energy, because those prices fluctuate a lot, that's why the Fed pays closer attention to the core CPI number. And with that number escalating, getting worse, the Fed will have to act more aggressively. Yeah, I understand everyone was overly bearish and a hot CPI was expected. Oh, I totally forgot to do this. All right. I understand everyone was overly bearish and a hot CPI was expected to some degree, but it still wasn't good news at all. No, it was not good news at all. Like I said earlier, the fundamentals of this market, they only changed a little bit with yesterday's new data point, and it was to get worse. Yesterday's new data point with inflation, core CPI going up to a high not seen since August of 1982, that new data point plugged into the fundamentals of this market made the fundamentals a little bit worse, meaning the Fed will not slow down, will not pivot, and may go faster and may go higher. I read a report today that said the Fed may go to 5% on the Fed funds rate. Like, that may be the high, 5%. So that would be 4.75% to 5%, because there's always that quarter basis point wiggle room, right? Even when we were at 0%, it was still 0 to 0.25%. There's always that 25 basis point wiggle room there in the Fed funds rate. They're most likely taking us to 4.5% by the end of the year. If they took us to 5% by the end of the year, holy crap, that is very dangerous. So, yes, it was not good news. The market yesterday, it was simply, the market hit a technical point at 3,500, which caused the computers to start buying. That was it. That was it. And then after the initial bid, then we had a little short squeeze pop off. And that's what caused that second big burst late in the morning. So that's what took place yesterday. So it's not good news. And that's why yesterday was a one-hit wonder. We're going back down. We're going to go back down and probably test that 3,500 area next week. We're 83 points away from it right now. We moved 100 points today. So, yeah, it definitely was not good. All right. Any other questions, or is everyone okay for this evening? Let me know. Let me know. If you're all good, then we're all good. Okay. I remember something similar happened when we hit 3,800-ish, and we had a big pop to the upside. There we go. Yeah, there are certain levels plugged in, like the 3,800 level. Why are these numbers important? Why is 3,500 important? Why was 3,800 important? Why was 4,250 important? Let me adjust this chart here. I want to back up a little bit. 3,800, 3,500, 4,250. Those are important levels because of symmetry, because those were Fibonacci retracement levels. Okay, I'm just trying to get this chart here so you can see. I have these blue lines going across the chart. Okay, those blue lines are the Fibonacci retracement lines, and what they're anchored to is the March 2020 low up to the January 2022 high. Now, there's symmetry on these numbers. So the first one on our way down, okay, it was a pretty big one, and it was the 4,250. Okay, we had support. Oh, come on, highlighter. 4,250. Okay, almost came down right there. Was support right there. Was support right there. And then we had this huge fall right here, and it fell right to that 42.50. Then once we broke under that, where was the next area that we fell to? We fell to the 3,800 area right there. That's the next Fibonacci number there. Right there, it acted as support. It acted as support right there at 3,800. Then this week, 3,500. The next level where we have a Fibonacci number is 3,200 down here. 3,200 is down there. And if we want to go lower, then we're all the way down to 28.15. So that would be scary going all the way down there. I don't see us going any lower than this area here between the 3,500 and the 3,200 area, okay? Between those two Fibonacci numbers. Now, if we look, where does that line up? Well, that lines up right here. And then right here, and through here, okay? So there was a lot of support at 3,200. If we look at January of 2020, after we passed the 3,200 level, we came back and we found support there. And then when we were coming out of the March and bottom and we were climbing up in April, the 3,200 area was resistance. And then when we got to the September and October highs of 2020, the 3,200 area acted as support for September, the September and October lows there. So a lot of support and resistance at that 3,200 level. And then, of course, at the 3,500 level, there was a ton of it. It was resistance for the September and October and even August 2020 tops. It was back tested and it was used as support in November of 2020. And then, of course, this past week, we come down, we find support at 3,500. So these Fibonacci numbers, they're important, especially for the computers. The algorithmic trading, they see these numbers and they act on these numbers. They also act on pre-programmable technical analysis because it's very straightforward, right? For the most part, there's some lingo to learn with technical analysis and different shapes and patterns, but once you learn the lingo, then it's real easy to recognize the patterns and then what those patterns mean. So it's just another way of speaking technical analysis, but once you learn the language, you're good. And the computers, it's really easy for them to understand numbers, and they can understand these and act on them. So that's why 3,800, that was an important level when we were coming down. And when we were trying to go up and start the summer rally, it really kicked off once we got past that 3,800 level. So, yeah. The Fibonacci is really easy to use in TradingView. Over here, thanks for the emails. They were well written and informative. You're welcome. I'm informative. I want them also to be actionable. I want you to be able to take the information, whatever it may be, from the weekly expected moves, from the notes on the market or notes on economic data or the numerous trade setups, whatever it is. I want you to be able to take that information and put it to action, be able to use it. I don't want it to be nonsensical words, right? I want you to be able to use them and help you along your investor journey, wherever that may take you. But I do greatly appreciate that for sure. Absolutely. Thank you very much. Okay, so there's the Fibonacci and why those levels are important, including that 3,800 that you mentioned. They just mark off symmetry, significant mathematical equations, right? Just like the weekly expected moves and how they have a 68% accuracy rate, right? The options market has it down flat. I mean, pat, they are the most efficient aspect of this market. I know over the past couple of months, they've been a little on the inefficient side, but that just goes to show with this increased volatility comes a little more chaos in the market. All right. Anything else? Any other questions that you all may have? Plug it in now, or we can wrap it up. And again, if you want to get our big picture take that comes out on Saturday, or our weekly expected moves that come out Sunday evening, or the numerous bits of data that comes out throughout the week, just hit that first link in the description. And also, if you could, just click the like button. It really helps out. Okay, all good for now. You have a awesome weekend too. All right, well, we'll wrap it up here. Thank you so very much for joining me this evening. I greatly appreciate each and every one of you. Again, investor community, Saturday, look out for the big picture. Sunday evening, look out for the weekly expected moves. And Monday, we'll be back after the market closes with a live stream to answer your questions and to look at what happened, why it happened, and what to expect. And of course, that's it. There is no of course. The of course is thank you. And have a wonderful evening. And I'll see you in the next one. Take care.